This panel is going to be all about being bankable, right? I think there's been a lot of changes in the lending environment, obviously, over the past couple of years with interest rates. And how has that affected us? There's a lot of different variables affecting the value of properties and what's kind of going on in the lending environment. So what I'd like to do is let's talk about the lending environment as a whole and the market as a whole and what's going on from what banks are looking at right now. Is there money? Is there no money? Are things drying up? Or is there plenty of dry powder on the sidelines? What does that look like? So, Chris, I'm going to start with you. And obviously, if anybody has questions, you're welcome to raise your hand. We'll bring a microphone over to you, and you guys can ask any questions as we go along. But I'll get some things rolling. So, Chris, can you give us a little bit about where's the market right now on the financing side of things from an institutional lending standpoint?
Yep. So I'll give you a 30-second rundown on what I do and kind of where what we see, so that you get a frame of reference for where I'm coming from. So we arrange all types of institutional capital for all different types of real estate deals. So banks, credit unions, life insurance companies, Wall Street money, for all different product types. So office buildings, shopping centers, apartment buildings, self-storage. So there's abundant liquidity for institutional money, right, with the institutional lenders. The life insurance company's got plenty of money to put out. Wall Street has an insatiable appetite for putting out loans and buying these loans, but the money's more expensive. So the transaction volume's way down. And the banks are in a little bit of a tough spot because all of the loans that they made the last several years, they're not getting paid back as much as they would have thought, right? So
meaning people are not refinancing, paying those loans off, right?
Yeah, they're just extending their loans, or they just aren't getting prepaid early, right? The average life of a 5-year bank loan is probably 2.5 years. Right now, it's 4.5 years because people want to hold it to maturity because it's a below market rate. So banks are just not in a position to be lending as much as they used to be. So I like to say that if I had 10 banks for any given deal, I probably have 3 today, right? Because 7 are on the sideline. So there's still capital out there, it's more expensive, and it's just more conservative.
And I'm sorry, I should have done a better job introducing. So Chris does all commercial mortgages. He's been lining up my financing personally for, I don't know, going on a decade now, and has lined up hundreds of millions of dollars of loans for me personally, and has done billions of dollars of loans collectively for legacy family members and commercial empire attendees and other folks that have that are in his network that aren't even part of legacy or commercial empire. And so understands this market and understands the institutional financing side of things better than anybody else that I know. Speaks on stages all over the place on this stuff as an authority. So has a ton of insight there. Kelly Garrett owns Rehab Wallet. Rehab Wallet is a hard money lending firm, and you guys did over $100 million last year, right? Trying to do about 150 this year. Is that
125.
125. $125 million in single-family hard money loans, and I think some smaller commercial stuff too, right?
Yep.
And she's had that business for several years now. She's also a limited partner in a whole bunch of different investments. She's a general partner in a whole bunch of different apartment complexes as well, and her background's in flipping of businesses. And so, and then Jack Lupo is a partner with Whit McCarthy in Consistent Capital, and you guys are partners too, right?
Yep.
And they're kind of the stabilized, right? Like once the property's stabilized, if somebody wants to buy it and rent it and then hold it, they go to Consistent Capital, and Jack's team would help put long-term debt in place on stuff 10 units and smaller.
Correct.
So, right? So up to 10 units, long-term debt, talking to Jack. 10 units and bigger, talking to Chris, right? And hard money loans, short-term, quick, moving some money around, got to buy something, transactional funding, or any sort of like rehab type funding for either single family up to small commercial, Kelly's your go-to. Does that make sense? Cool. So Kelly, what are you seeing in the hard money side of things? And you guys lending, and you guys raise a lot of money from private investors, and then you guys then deploy that money as hard money loans. So talk a little bit about both sides of that. Where is there a need? I know a lot of people were a little bit, I don't know, I wouldn't say squirmish, but slower to invest and passively invest in some different things. And I think a lot of people tightened up quite a bit at the end of last year. How have you seen that change over the past couple of months so far going into 2024 of both people wanting to invest and people wanting to borrow?
Well, like Tim said, we have a fund, a debt fund, that we raise money every day. Our minimum investment is $25,000, so we're doing $25,000 at a time. Our average investor is about $103,000, so we're raising that. We've raised over $130 million doing it that way, $100,000 at a time, $100,000 at a time. And the ease of it is nothing's easy, especially at those numbers. Nothing's easy. I think that we've had to add people to the org chart over here to do that much volume because the demand on the lending arm has been a lot, I guess, heavier, bigger than over here on the money raising capital side. So we're every day raising and every day lending out and every day having to have a big balance in between both of those sides. But the demand is still strong. I think we've had to work harder in the last year than we ever have on the raising capital side. So we'll pay our investors up to 8%. We've raised that. We raised about $100 million at 6% at a time. And then when the debt climate kind of raised, we raised that up to 8%. We do some side letters if you're over $1 million coming in to our fund, and we have a few of those, and we appreciate that. The Roushes, appreciate you guys. We have a lot of people in here that come into our fund, and we appreciate that, and we're going to be good servants of everybody's money. So, but it's $100,000 that we're raising. We're at having dinners. We're having we go to where our borrowers are or our investors are. So wherever our avatar is where we're headed. So our money raise side is at venture capitalist meetups, because inside those VC meetups, there's also people that they have money, right? And so that we might build relationships. We're constantly building relationships with social media over here, and then I got to go over here and build the relationships on the borrower side. So, I've always said that I've been in the business of relationship building for over 2 decades, and that's all we do is build relationships and then be good stewards of people's money, and that's what we got to do every day.
Yep. I hear doing the work, right? Everybody wants everything to be easy. They want to press a button. They want to post on social media, send out an email, and poof, right? Have instant success. But it reminds me of, we're shy. Remember, we were sitting down, your whole business model, dude, is knocking on doors when nobody else is knocking on doors, and everybody wants to send out, pay for Google ads or Facebook ads and Instagram ads. These guys just go and knock on doors, build a business that's doing $250,000, $300,000 a month in 8 months, right? Because of just knocking on doors and doing the work, and that alone differentiates you than anybody else. And that's what you guys are doing. You're sitting down having dinners. You're actually getting on a phone call.
On the borrower side, it's more of dinners and meetups. On the investor side, it's more dinners and meetups. On the borrower side, it is a ton of meetups, a ton of real estate investor groups that we sponsor, that we have our booths, and that we're at on a weekly basis. And our teammates are out there constantly every single week at a meetup, whether it's in Charlotte, North Carolina, or Columbia, South Carolina, or Charleston, South Carolina. And Dusty and I, we run a very large meetup, and on purpose, very intentional. And so that's where our borrowers, that's our avatar, so we're going to be at those places every single week and working hard.
And I think the key there is you're doing it every single week. You just mentioned, hey, we're heavier on borrowers than we are on money right now. But if you turn off the spigot on borrowers and you just focus on raising more money, then all of a sudden all this big tranche of capital comes in and you don't have anybody to borrow. You need to be prospecting all the time in the key pillars of your business, right? One of those is raising money. One of them is sourcing deals or sourcing borrowers or whatever that is. So you got to be doing both of them at all time. And like you said, it's a balancing act for sure.
That's right.
Jack, how about you, man? Tell me a little bit about what's going on in the build-to-rent space or the BRRRR space, and anything along those lines of how is it getting people financing right now?
It's a unique time for our space. Been in it for about 10 years. It's the strictest it's been. We kind of flow a little bit more with Chris's world because our money is institutional. So with that, you've seen a tightening on leverages. You've seen an increased minimum FICO score required. So from the Bankability side, I would say our borrowers that are active, you're seeing that higher profile of people that are wanting money. It's interesting too because from a standpoint with capital more expensive, obviously on the debt side, the stabilized money is more expensive. So to make those debt services work, we have a minimum debt service of around 1.2. So we want to make sure we're protecting our borrowers.
So explain that real quick.
So basically, the income that you're generating from a property on the residential side or the multi-side has to equivalent to at least 1.2 of what your monthly payment is with your taxes, insurance, your rent. Basically, it's a way to protect you as an investor, too, to make sure that you're not underwater every month, as well as a lender to make sure that you're able to make those payments.
So if your mortgage payment is $1,000 a month on a single-family rental, you need to be bringing in $1,200 a month,
Correct.
1.2%, or 1.2 times what that monthly mortgage, what your debt service is.
Correct. And on the other side of our business, which is new construction, and that's we've been talking with Kelly's group a lot about too, is we've seen a big tick up in that. In the construction side, people aren't as rate sensitive. So even though rates have fluctuated a little bit on the construction side, they're not as sensitive to it. And banks,
Because it's short-term money.
for its short-term
So
money.
it's a cost of doing the business and whatever it is, what it is, right?
And the banks have definitely pulled back on the leverages, the traditional banks. So we're seeing an uptick with investors building spec homes, things like that, that want to keep a little more cash in their pocket and not have to leverage as much on the front end.
So this is a lot about, I wanted to get an understanding of where the market is right now. And you had alluded to, you need to be, the higher qualified folks are getting loans easier, better loans, potentially better terms. What can somebody do to make themselves more bankable in your eyes? I want to hear from both of you guys from an institutional side, and then I want to hear from more of an individual side, because I know Kelly's more relationship-based lending, right? So can you talk a little bit about that? Like, what are the components, what are the variables that people need to be looking and paying attention to, and how can they increase each one of those different components in order to make themselves more bankable?
Yeah, I would say credit score drives our world, but liquidity as well.
All right, let's talk about credit first.
Yeah.
So credit, how can we clean up our credit? How can we fix our credit? What are things that the bank's looking for that we can do in order to then, do we need to pay stuff off? Do we need to
consistency.
open more revolving lines? Like, what does that look like?
Yeah, I can't speak too much to that, but other than just consistency in your credit and making sure you're making your payments. We'll do a quick dive on your score. If your score is kind of right in that sensitive area, we'll just want to make sure you don't have lates. Lates are the biggest thing as a mortgage company that we'll look, and that's our biggest red flag. If somebody hasn't been making their payments with their previous lender or with Rehab Wallet, things like that, then that is a very tough position for us to be, because we got to trust that you're going to make our payments. So when it comes to credit, we want to make sure there's no lates on there. From a standpoint of also putting yourself in a good position, this group's perfect for it because strategic partnerships. It doesn't just have to be you. There could be partners. We have a lot of borrowers that come to us and maybe they're not in the best position at that time, but they know somebody in their network that is very bankable and they trust. And we're seeing that more than ever now, where people before were like, I don't want to bring on a partner, I don't want to align with somebody else. But in this market, having those trustworthy groups like this and being able to reach out to a group and say, hey, I have this project and it's a can't miss project, but I'm in a position right now where maybe my credit's not so good, or I don't have a ton of liquidity, and reaching out and finding those strategic partnerships have been I think the best way people have navigated this market.
Mm-hmm. I mean, it's a co-sponsor, and that's a standard thing in the commercial world, right, Chris? So talk a little bit about the bankability, what lenders are looking for, and then how to gain access to those things.
Sure. So commercial space is a couple key components. The first is a little bit more gray, which is experience, right? So lender always wants to make sure that they're not the first one lending you on this property type, right? It's not as simple as, you got to have, if you want to buy a 100-unit property, you got to have a 100-unit down the street, but you got to have some sort of comparable experience. So it's a little bit gray. So experience is one thing. The second thing the lenders are looking for is financial base, and that's net worth of the loan amount, right? $10 million loan, we got to have $10 million in net worth, and 10% of the loan amount in liquidity. So $10 million loan, we got to have $1 million of liquidity. So as Tim mentioned, that's amongst the people signing on the loan, right? So if that's 3 of you, each of you have a $4 million net worth, then we're fine, and $1 million of cash between all 3, right?
Yep.
So that's the 2 components.
And it's pretty standard that if you don't have the net worth and you don't have the liquidity, then you would partner with somebody who would, right?
Yeah, that's right. You could find that partner in this room. We can help you find that. It could be just your rich doctor buddy down the street, right? Everybody adds to the partnership.
If you have the experience, the other person who may not have, they might not need or have any experience, that's okay, right? Because if they just have the liquidity or they just bring the net worth, but you have the experience, it checks all those different boxes.
Yeah, that's right. Lender's just looking at it in totality.
Yep.
I will give you one, though, one nugget to leave with that's probably not going to get mentioned anywhere else, and that's contingent liabilities on the balance sheet. So what lenders are looking at today is they're looking at your real estate own schedule and they're saying, you have 10 loans, how many of those are fully guaranteed? How many of those are personally guaranteed versus carve-outs only? Right, so if you have a personal obligation to repay the loan, that's a contingent liability. So what we're advising our clients to do is to get off that recourse with more of the institutional money, because the banks are paying a lot of attention to that right now.
Mm-hmm. What kind of documentation does somebody need to bring to you and have prepared in order to then go and get institutional lending? Like, what are the things that we could be working on or make sure that we have so that way we can provide them to you, so that way it's a smooth process on obtaining bank financing?
Yep. So institutional money is 80% focused on the real estate, 20% focused on sponsorship, right? So if you got a bigger deal, something that's more stabilized, really we're only asking about the property. Rent roll, profit and loss statement, past couple of years of historicals, tenant sales if it's a retail, something like that. And then as long as the sponsorship checks the box, no big deal, right? But if it's a smaller deal, it's a construction deal, the likely lender is a bank, right? A bank is 80% focused on sponsorship, 20% on real estate, right? So what's in your control as a sponsorship is to have a few key things always handy, always updated, right? Personal financial statement, right? All your assets, all your liabilities. Verification of liquidity.
From an individual standpoint, Kelly, who are you guys looking to lend to? Because you guys are more asset-based, right, than you are, but you're looking at the individual too, right? And you have a lot of repeat borrowers, and you know who your avatar is. Talk a little bit about how you identify that and who you're lending to and what the commonalities are among those folks.
Yeah, when we opened Rehab Wallet 3 years and 8 months now, I flipped for almost 2 decades, so I knew what a hard money lender felt like, and some of the things that I hated about a hard money lender, I wanted to change. And I wanted to be truly asset-based. I didn't want to be credit-driven. I wanted to be asset-based, but obviously the strength of the borrower is very important. So we also will not go with just a new borrower. We ask that borrower to lock arms with somebody that is experienced and come in. We don't pull your credit score. For whatever reason, I've never believed in that. I think it's just my past mortgage experience. Used to see some poor soul didn't get to do a loan because they had a $10, $50 like hospital bill. Who's had that, and their credit just drops for something so silly. So I'm looking at the borrower and I'm looking at the asset. If I had to take that asset back, would we want that back in our portfolio? Again, I flipped for 18 years, and we're training our gatekeepers, which is our loan originators, to say, you know what? If for some reason life happens, and life will happen, and we'll have to take a property back, would I want that back? Would it be an asset that I want back in my portfolio? Mm-hmm. So we're truly asset-based. We're very low documentation, no credit, but we do ask, obviously, scope of work, do the normal insurance. We don't worry about the verification deposits either. So that's what Consistent Capital, of where Jack is, we started that in August because we were seeing some deals stay on our books, right, on Rehab Wallet's books. So you want to get in and out of our deal because we're expensive. So 6 to 9 months we want you out of our loan and then go to a long-term lender, one of these 2 guys. And so we decided to open up our own long-term lending arm and take control of that, and be able to give that, Angela, what do you call it? My COO's out here, knock your socks off customer service. That's really what we want to do at Consistent Capital and at Rehab Wallet, so that you come back to us. And 85% of our borrowers are repeat borrowers.
Wow.
85.6% of our borrowers are repeat borrowers.
That's awesome. Again, if you guys have questions, raise your hand. Anybody? And we have another one up here too, Trevor.
Is there a magic adjusted gross income or taxable income they need to show? We always do a lot of tax planning for people, and the big battle is I can make it so you can't borrow.
Great question.
Is there a magic number for certain types of loans?
So, Chris, let's start with you. My tax returns have losses on them every single year, but I'm still bankable. Can you talk to that?
Yeah, I think liquidity is way more important than income. I mean, if your loss is because you run a business that loses money and we can't really show why the business loses money, right? Add back depreciation, those sorts of things, that may become an issue. But liquidity is more important to the banks than income
On the larger commercial stuff.
Correct.
Now, when you talk about something a little bit smaller, well, you're still working with institutions. Does it change for you guys?
No, we're kind of that middle ground as well. Am I breaking these? Or? We don't look at tax returns. So we're just looking at stated income. So for us, we're technically still an asset-based lender, so more in the realm of Kelly. But we're kind of that middle ground between those two. But tax returns will not be something that we would require nor look at.
What about with a local bank, Chris?
It depends on the type of deal, right? I mean, if you're and where that income is coming from, right? Like if you own real estate and that's where you derive most of your income, right? You're probably not going to show income. But if your, only source of income is your 9-to-5 job and it's not enough money to cover the debt service if this thing doesn't work, then the bank could care.
Yeah.
It just depends on the type of property, right? But what you're purchasing, right, is going to throw off cash flow at some point, so they're going to be looking at that most.
Mm-hmm. Looking at that as collateral. Good. We have another one up here, Fernando.
On the 10% liquidity that you have to have in the bank to get financed, obviously there's probably many people here that don't like to keep money in their checking account. So what other places does liquidity mean? Like what other areas could it be like in CDs? Could it be invested into a fund where the bank would see it as like, oh, that's liquid? What represents 10%?
Yeah, liquidity is just something you can get your hands on within 30 days, right? So cash, marketable securities.
Well, like retirement accounts, like you can get your hands on them. That'll be a fee, but that's considered liquidity, right?
Yeah, bank would just discount it significantly.
We're constantly doing inside our fund because we have a liquidity option in our fund. It's like a high-paying CD, so you can get your money out if you need it. We're constantly doing letters for banks for our investors to use that as some type of liquidity option.
Well, that's a good thought.
Along those lines of the market change, before in our world it was like for 401ks you could use up to 70% to qualify, and then they changed that number to 50% once everything was getting a little shaky. So that was another thing that changed from a liquidity standpoint.
Do you recommend on the liquidity that is more important than income, people that have assets to get maybe them reappraised? Like if somebody has assets but you're losing every year, but you have assets, do you recommend to get them appraised so the bank kind of has an idea how liquid you are?
Yeah, so an asset that needs to get appraised is probably not liquid, right? So art or jewelry or real estate wouldn't be liquid, right? So marketable securities that you have in a brokerage account doesn't need to be appraised because it's it's got an account statement.
What about? And we're going to be talking about crypto tomorrow a little bit. I've got a panelist coming up here and talking about passive investments. Does crypto count? Which, by the way, is on a friggin' run right now.
It is. I went back to the room at lunch, and it was up 12% today.
Today? Has it capped 65 grand?
Bitcoin 63.5 or something.
63.5. The highest it's ever been was 65, right? And 69?
69 now.
And it's about to pop it. So it's been on a run over the past couple of months, especially in the past week. So does that count?
Yeah, the problem with, the pros and cons of crypto is you can't verify to whom it's owned, right? Or with who it's owned by, right? So it's hard to prove that liquidity. Now, if it's in an ETF, right, with your name on the account statement, then that absolutely counts. But if you keep it in cold storage, you just can't verify it, right?
Right. Did you have a question? Oh, okay. And then there's another one up here.
This thing working? Hey, can you guys explain to people what kind of runway you're looking for your loans? You know, I'm in the last minute business. You know, people always need something from me like the day before it's due. How much runway do you guys need for your commercial loans, or your rehab wallet, or your DSCR loans?
I'll start probably the fastest, just because we have we're using our own money, so we can close. We've closed in 12 hours. Where's Ashley? Ashley, I've closed something for her in 12 hours before. That is not what we want to do every day, but it's just 72 hours typically after clear title. Sometimes we're at 48 hours, just according to how many loans we're doing, but we can close super fast, and that's typically, we're dealing with those wholesalers and those fix and flippers that are buying for wholesalers, so they want to close as fast as possible, so very short runway for us.
For us, it's, I would say, about 3 weeks. I would say mostly because we require some third-party reports, so we get a full appraisal on every deal. And then what I'm also excited about being here, too, is like working with good title companies, insurance providers. Those make or break because speed is how you differentiate in our space as well. And having good partners that are going to do what they say, as I like that part, the integrity piece. For us, those third parties kind of make or break our timeline, but I would say on average it's about 3 weeks, but it can be faster if those insurance title appraisers get us those reports.
Good. Litzer, how about you guys?
So we typically close 40-ish days from signed term sheet, but it takes us usually about 30 days to get to signed term sheet because we're gathering information from the sponsorship to put a package together, to go out to market, to go make a market, to bid them against each other, to sign one up, right? So it usually takes us, a week to 10 days from the receipt of information to get a book together. It takes about 2 weeks to make a market, right? And we close 45 days thereafter. So we like to say 60 to 90 days from when we get started.
And what you'll find is the interest rates reflect that,
Exactly.
right? If you talk to Paul Vincent, they have people who come to him the day of closing saying, hey, we need $400,000. Well, guess what? They have guys that can fund $400,000 at the day of closing. They're attorneys. They can draft up the paperwork themselves. But you can be paying a couple of bucks for that, right? And then same thing, Kelly can close inside 12, 72 hours, but it's going to be a higher rate, right? Close within 3 weeks, you get a lower rate, but it's a longer timeline. The lowest rate is going to be the longest timeline, right? And so it all just kind of pairs up and reflects that way. Go Ryan.
Yeah, kind of a two-part question, but along the same line. So more for Chris, when you talk about experience, like what are you looking for? What can kind of help us build that credibility? Like example, I have over a decade experience as a regional and asset manager for mid to large multifamily and some limited partnerships, but I'm trying to bridge that gap to be a general partner. And does that hold any weight for me, or do I need to be bringing on a loan sponsor that is actually general partner already? And then more for the other two, if I'm looking to do single family or small multifamily, fix and flip type deals, when you say experience, like what does that look like for you guys? Are you looking for HUDs, like case studies, or like how do we basically prove that to you or the lenders?
Yep, good question. So how does somebody grow their credibility, right?
Yeah, look, it depends on the lender, right? If you have ancillary experience, stuff that you previously worked on is close by this stuff, you're buying something small, you qualify from a financial standpoint, bank, credit union probably is fine with that, right? But the agencies that would not qualify.
That's
right?
Fannie and Freddie. Yep.
That's Fannie and Freddie, right? Fannie and Freddie might say you need 3 previous assets owned in the last 18 months, right? The latest of which, or the furthest back of which, hasn't been purchased less than 18 months ago. So there are some more firm rules with Fannie and Freddie, but a bank can be a little bit more gray and subjective.
I mean, the key is it's not about this deal, right? It's like, what does this deal set you up for? And so this deal, you bring in a co-loan sponsor, and you find the deal, you operate the deal, and you say, hey, I want 10%, 20%, 40% of the deal as a GP, as a general partner. That's what they're looking at. You can be in thousands of units as a limited partner, but that doesn't check the box for that piece, right? And so as a general partner, hey, all right, so you bite the bullet on one, you split some equity with somebody else who does have that experience level, and boom, now you're on this deal, right? And you do it a second time and a third time, and then all of a sudden, there's two ways to do that. One is you either bring in a co-sponsor. The other one is you organically grow your portfolio. And that's what I did. It takes a long time, but I didn't even know that a co-sponsor was a thing when I got started. And so I bought an 8 unit, then I bought a 16 unit, then I bought a 31 unit, then I bought an 80 unit, then I bought a 60 unit, and it just kind of grew to a couple hundred units where now I can qualify on my own and just did it organically. So kind of weigh that out. Was there a second part to yours?
Yeah, I can answer the second part about experience. We too want somebody with experience. So what does that mean? Well, anybody here that has flipped a property and has rehabbed something $100,000 and above, like the average flip is on a rehab is about $30K. But let's say you're doing something on $100,000 and above. That's it takes a big boy or girl to do $100K rehab. It just does. And so we do want to see a HUD. If we get a deal like that and you're asking for $100,000 in a rehab and you're purchasing it for $200K, we're going to ask for a HUD that shows that you've done a $100,000 rehab before, because it takes a special person to do that. Mm-hmm. A historical building, we live in Charleston and we got about 70% of our businesses in South Carolina, and I would say, Ange, help me, 20-something% in Charleston. So you got to be able to handle the historical piece of downtown Charleston if you're flipping there. So I want to see that you have flipped a property in downtown, because permitting takes forever to do that. And so, yeah, we're going to ask for HUDs to prove that you've done it.
Mm-hmm. Yeah, and we'll verify on title, pull title reports, and for us, again, being asset-based and not as strict, you could be 5%, 10% partner on that. Now, where it gets trickier is it's risk for us. So on like construction deals, we'll require more experience, maybe a minimum of 5 ground-up construction projects, and we verify those again through pulling title reports, and then your ownership will be reflected in that. Yeah.
Good stuff. We had another one over here.
Yeah,
Michael.
I have a question on the liquidity for probably Chris more so than the other two. How does it impact having several properties that you own free and clear, since those are not really liquid assets? Being able to, they're putting leverage on those is more important before you go into another deal, or can you use those as some type of collateral?
That's a good point. Yeah, can you throw a quick
If there's
line of credit on
yeah,
there?
if there's a line on it. Yeah, if there's an undrawn line or there's availability on a line, if you have a statement like that, we could count that as liquidity.
Ooh, I like that. Good question. Good answer. So talk a little bit about that. That's something that you need to prepare for right now. If you own some properties free and clear, go to the local bank, throw a line of credit on it, just don't draw on it, and once you have hey, here's what the open line is, they just give you a statement on that, hey, it's not drawn on, and then you can count that as liquidity in that property.
Yeah, that's right. So I have a client right now, he owns an industrial building free and clear. He's got an office building that is going to be in trouble. Not his fault, right? Just underperforming office building. So today, we're going out to get a line on the industrial building, because it's a $6 million industrial building, he owns it free and clear. So he throws a 50% line on there, so he can draw on it if and when he needs it for the office building cash in refi.
Love it. Yeah, it's great, because that's personally, that's been a thing of like, dude, do I pay off this property? But I want the liquidity because we're growing, or I'm signing refinance loans, I'm signing new loans, acquisition loans, and it's like, well, I don't want to pay it off because then but if I just turn around and get a line of credit on it,
it's all
great.
about your business plan, right? Most financial guru might tell you put leverage on it, right? Because if you could borrow at 6, right, and even if you put it in a money market, you get a little over 5, right? So you're losing a little bit of money, but now you have flexibility.
I like the peace of mind,
move
man.
quick.
I like the peace of mind of having it paid off, but still having access to the cash and liquidity. I think that's a great balance. That's a good question. We had another one over here?
Yeah, I got one. So our guys, me and Corey and our guys, we like to keep our money on the blockchain because we feel like it's safer there than in the banks, frankly. And we can verify funds, we can do all that, but we don't want to freaking move our money off the blockchain until there's an actual deal to be done. You know what I mean? And so is there a way to be able to use those funds as liquidity? We can, once again, we can verify that. We've got guys with huge bags that are just like frothy looking for real estate deals right now and over the next year. But they don't want to do anything with that money until like, hey, there's a deal and it's time to pull the funds and go and do the deal itself. So how might somebody that's looking to do deals with those types of funds, how might they do that, would you guys say?
Could they move the money off the blockchain, show a picture of their statement, just do it at the end of the month and then move it right back on?
Yeah, I mean, or you just do it, I mean, you could say you do it quarterly, right? I mean, if all of your liquidity is on the blockchain, like, you probably want to do it more frequently, move it off, move it back on, just to verify it. I mean, the other thing that we do sometimes for guys is like, if you got low leverage on something, you might take a loan from somebody, right? My money goes into your bank, it's a loan, you basically add that as a loan balance to your, on the real estate owned schedule to show you have more debt, but now you have the liquidity.
It's tough because some of these guys have a lot of money. Like one of our friends has 300 million on the blockchain, and he's looking for real estate deals. And so he's not going to want to go into cash and go back in, you know what I mean, until he's got the.
Well, I mean, is he trying to qualify for real estate and operate real estate deals on his
He wants
own?
to buy apartment complexes. I mean, that's why he's part of our community, is he's looking for really big deals, assets to get into outside of crypto. So these are some of the things that we have to find and navigate for our community now, while the timing is here.
Yeah, I mean, does it cost anything to take money off the blockchain, put it in a bank account, and then put it back in?
There's a lot of implications, and so, yeah, there's a lot of problems with that. Because we're in DeFi, right? We don't go in, we don't mess with Coinbase and Kraken, and Coinbase just got shut down today.
Yeah, I mean, look, the honesty is the best policy, right? I mean, if he's really got that much crypto and he wants to buy an apartment building, then you just walk through the front door with the lender, right? I'm using this cash, it's right here. I mean, you can verify it, it's just not, in his personal name.
I think if he's got that much money and he can show it right there, somebody's going to give him the respect and credibility and the opportunity to say, hey, listen, dude, I'm not pulling my money off, right? You can posture up a little bit when you got that much. I think what we're talking about is a little bit less than $1 million, right? And trying to use that as liquidity in order. But if you got that much money sitting in crypto, somebody's going to give you the respect and credibility and allow you to swing the bat at a deal, right? I know if I was, if he wants to buy one of my buildings, I'd say, yeah, all right, show me the statement, show me whatever. All right, cool, let's engage in the conversation. Right. Yeah.
Verification process, I guess you'd say. So that's what we do all day. So we can kind of educate you and
Yeah.
prove that it's his funds, his wallet, that it's there.
Yeah, so from a seller standpoint, I think you can definitely overcome any obstacles there. From an institutional lending standpoint, they want to see it in the bank account, right? And that's just, dude, you get, so the good news is you can go to the seller, you can contract the property, and go through all the due diligence, because it gets you there enough, and then they're far enough along where he knows he's going to be buying the property. Boom, now, because dude, you got 40 days or whatever, or 30 days in order to start shopping the loan anyways. So like, you're finishing up the due diligence during that period, then you take the money out once you know that you finished due diligence, you know that you're going to close, and then it just has to sit in your bank account. It's only two statements, right? Yeah, so if you move the money in today, a statement comes out tomorrow, and then the statement at the end of March, now you got two statements, the money's only out for 32 days. Does that make sense? Yeah, I mean, it's a lot of time in crypto, I get that, but at the same time, he's able to offset a lot of those gains by buying real estate.
That's why he wants it, right?
Yeah, 100%. Oh, one over here?
My question was, it's actually for all three of you, but I know Kelly said Charleston, South Carolina, North Carolina. Is there a geographical restriction to where you loan the money to?
Not on our side. The restriction is where, I told you we raised $130 million, and we've done, what, $250 million or $275 million at this point. I know it sounds like a lot of money, but in the lending world, it's not a lot of money, right? So why do I need to go to Wyoming when I don't understand Wyoming's weather or Minnesota's weather, right? Why don't I stay in the Sun Belt where I kind of understand everything? So that's why we stay in the Carolinas and Georgia, because we understand migration and jobs and weather, versus we don't have to go. We don't have the money to go that far, right? There's no sense in it right now until we get dense enough in these areas that we're in. So that's why we've chosen to stay in the Carolinas and Georgia and a part of Ohio.
So does it matter
We follow the borrowers, really.
where the borrower is, or does it matter where the property is? What's more important? Does it?
It doesn't matter. I care where the property is more so than the borrower. So we might have a borrower that lives somewhere else and has a team though in, let's just use Ohio for example. We've for whatever reason, Ohio's been, I think, number 2 now of the state that we're in, behind South Carolina, because we followed a borrower. So and it happens to be some borrowers in here because of Tim's relevance to Ohio and to Charleston. So we're following the borrowers and the operators that can fulfill that 6 to 9 month term that we're after, to just borrow it, rehab it, pay it off. That's all we want. So we're going to follow the borrowers.
Litzler, how about you?
Just all 50 states.
All 50 states, and it doesn't matter if the sponsor's in one state, they're buying a property in another state either, right?
Correct. It might matter to the bank, right? But the institutional money doesn't care.
Right. The bank wants local sponsorship, usually. They usually want somebody who's within driving distance of a couple of hours of that asset. But from the institutional side, not as much. Jack, how about you?
Our footprint's been focused on the Midwest and the Southeast. Midwest is kind of newer for us. I'm from Indiana, so I'm happy about that. I know there's a lot of Ohioans here. But geographically, we came from a world, our previous company that got sold, we did nationwide. We wanted to get away from that on this model, mainly because, like Kelly was talking about, we're working intimately, we're building relationships with these investors, so we'll go to states that they want to go in because we trust them from a standpoint of we're betting on them as well. But we want to focus on the Southeast Midwest. We like those markets, the stability of those markets, and the people in general. We've enjoyed working with more. So over that decade, we've kind of decided, and our partner that knows a lot of people in this room relocated to Charleston. And so we're starting out Charleston, Nashville, Southeast, Midwest. And we've done deals in other states, but it's been borrower specific. Because they wanted to go there. And
so you guys could go in other states. You just choose to try to stick with certain borrowers.
Yeah, there's only a couple states that we won't go into, and that's for licensing reasons. In the lending world, like California, Oregon, Nevada, certain states require more licensing from our standpoint as a lender, so we won't go into those states. We don't want to get involved in those states now. But we will go into other states. And the only thing that we require of our borrowers is that they set up before an entity registration. So if their entity is registered in Ohio and they're doing a deal in South Carolina, we just want to see that they're registered to do business in South Carolina.
Got to be.
DSCR loans for short-term rentals that are being built, so there's no history, there's no rental history yet to go off of for income. How are you guys, it's really for anybody, how are you guys seeing lenders look at that? So like AirDNA, which I'm finding is actually ridiculously low compared, like in our market anywhere where we're building, AirDNA is coming in super low compared to what all the local rental companies that actually rent the properties out are giving us projections for. So what are you guys seeing? Because we're going to start building to keep. I'm building to sell right now, but I'm going to start holding on to some of these. I'm trying to figure out what I need to get lined up to get debt put on those.
That's in East Tennessee, right? I think we talked about that.
Pigeon Forge, Gatlinburg.
Cool. Yeah, so it's a very rare product. I think that people that do it well, there's a couple companies out there in our space on the DSCR side. One is, we'll do it, but Vizio does a very good job as well. And we can talk, I can talk more offline too, but it's twofold. If there's historicals, they'll like to see the historicals, and those are very heavily weighted because what happens in the market is most people will look at just underwrite it to long-term rent, right? And most banks, most lenders, a lot of people will tell you they'll underwrite to short-term rental, but then you get 3/4 down the process and you find out that they're underwriting to long-term, which just doesn't make sense, especially in Pigeon Forge, where you might get $7,000 a month on a property, but long-term rent it's looking at $1,500. So it just doesn't allow you to leverage enough. So if you don't have the historicals, if you have a sponsor that has, the way we look at it is if they are operating another property within that same demographic, same area, we will allow that to use, and we will use AirDNA, but we'll use up to 100% of the AirDNA. Some people use a percentage of that, but we'll use 100% of the AirDNA if the sponsor can show that they're operating another property in that area, mainly because we want to see that they are performing in that area because a lot of the pro formas you'll see, and especially in short term, are fluffed. So we have to protect ourselves. So that's how we look at it. But it is able to get done, but there are few and far between lenders that, so I can help you with that when the time comes.
So that's if it does not have short-term rental history. Yeah. If it does have short-term rental history and you're buying it as a short-term rental, it's already a short-term rental, it has historic, then you can just use actuals, right?
Yeah, like they like to see a year.
And that's just super clean and easy.
Yeah.
But you can go off of, and you would essentially underwrite it like a business would be underwritten as opposed to like a rental property.
Correct, and they still, the appraisal, the property's value is still appraised, so you're still leveraging off that, but you're using the income to get to a certain leverage.
A higher leverage.
Yeah.
Got it. A lot of these problems can be solved with people right here in the room. And if it can't be solved with people here in the room, they can make a connection with somebody who absolutely can solve that problem. So, yeah, if you need a resource on that stuff, just connect offline. Was there another one over here? Josh, what's up, bud?
When we borrow money, it's always from a
Hold it up more. Can't hear you.
When we borrow money, it's always from a local bank. What's the advantage of going to like institutional money? Like, I've never approached that, so what would be the differences?
What type of property? What type of properties do you own?
Single family, multifamily, commercial type.
New construction. He builds.
Sure.
He builds townhomes. He builds single-family spec homes.
Yeah,
Right.
I mean, typical answers: more dollars, cheaper money, longer amortization, non-recourse, more interest only.
But that's
just better terms.
But I would say, from a construction lending standpoint, the local bank's going to be higher LTV, or higher LTC, right? Lower rate, better
The
terms
only
there.
reason to use institutional money for construction is if you're averse to recourse, right? Institutional construction lender is going to have a burn off of recourse once you hit C of O, or more leverage, right? Institutional money might be able to go to 90, 95% of cost, but it's just going to be more expensive.
We work with some people that use local banks strictly, and sometimes they'll come to us if they're just capped with their local bank. Maybe they have a certain amount of deposit with them that they've hit their amount of projects or volume that they can use. And so I'm actually working with a guy in Nashville right now that he's tapped out with his bank and he has a good deal he can do, so he has to do this one with us. But he'll use them for the majority of his business. It's just a one-off he's doing with us because his bank won't do it.
Do most banks require, if you have the construction loan, that you have to stay on a perm financing with them as well? It's got to go construction to perm, or I guess you see it in all over the place where it's just a construction loan and then you got to refinance this out.
Yes, we typically don't do just construction loans. We'd want to roll it into a permanent loan
Right.
on the back. So
Does that lender want to do that?
Well, I want to do it for you because I don't want you to have the bullet. If
Right.
something gets slowed down, I don't want you to have a maturity event. So it would roll into a permanent loan. So then it's just negotiable, right? A bank might say you got to pay some exit fee, could be a declining scale prepay. We may get it waived if you refinance with an institutional lender, definitely waived on a sale. It's just negotiable.
But they're not going to give you, like, let's say you build something, he builds townhouses or he builds a warehouse or, I know Roush's are building for some big retailers, right? And their cost of construction versus once the retailer goes in there and then leases it up, they're 50% LTV, right? If the bank gives them a loan and they want to top it off and take their cash back out or take out their lenders or something like that, they're not able to do that if it's a bridge to perm, right?
Correct. It'd usually be just one facility and it would just roll into a permanent loan. You could
Right.
structure an earn-out on the front end, basically saying, once a tenant takes place and my coverage gets to this level, top me off another predetermined dollar amount.
Yep.
It'd be an earn-out.
Okay, so that is a possibility.
The way we typically like to phrase it with the banks is we'd say, I'm going to come in, I'm going to invest all this money, I'm going to create all this value. We need a very cheap prepayment to get out of it because, even though I'm going to come back to you, right, and I'm going to want you to top it off, but your appetite might change. I may need to go elsewhere, right? So you got to have the flexibility to be able to go elsewhere.
I love it. I love it. So, all right, one more question. Let's do it.
Yeah, in terms of your personal financial statement in determining your net worth, so in your real estate owned, how do you handle your LP investments? How do you structure those? Because it can be very hard to determine what the value of those shares are before your exit.
Is you would have to, the equity is what your equity would be on a sale, right, after the waterfall kicks through.
Okay, but that could be 5 years down, and if you're looking at my sheet now.
Yeah, so I mean, typical waterfall says we paid $9 million, we put in $1 million, so we're all into this thing for $10 million, right? We put a $7 million loan on, and we use $3 million of LP money, right? And the GP shares would be typically paid out after the LP money is returned, right? So your promote is valued after the LPs are paid back.
When I do my
Are you
personal
talking about it from your LP position?
Yes.
So you invested as an LP,
Okay.
right? And so, hey, I invested $100,000 as an LP. That's $100,000. I have it on mine as an equity investment. It's listed with all the notes, like the personal loans that I have out there, and then any equity investments on my personal fund. I'll share mine with you. And then, so it shows $100,000. And then if I have equity beyond that, in that deal. Now, I'm an LP, I'm a GP in all my LP deals as well, right? So if you're just an LP, that's fine too, but you can put that on your REO schedule. Let's say you own 2% of a $10 million deal that has a loan on it of $7 million, I don't know, of a $12 million deal that you're into for $10 million, right? And part of your money is in there. There's $2 million of equity built into it. Your 2% is, what is that, 40,000 or 400, whatever it is, $40,000. And so I would put that as my personal equity value on the REO schedule.
Okay.
And then you could show the investment as a loan receivable. Is effectively what it is, right? You invested money, it gets a preferred return. You basically lent that money to the partnership. It would get repaid first. So loan
but had a-
receivable.
So you wouldn't
Pushback
have
from
it on your
banks.
real estate owned portion. You would split out your GP from your LPs. Because, yeah, same thing. I have equity both on the LP and GP sides. And I've been combining them on that real estate owned sheet where you're saying separate those out.
No, I haven't combined on my real estate owned sheet. So if I have 5% ownership as an LP and I have 25% as a GP, I'll just say I have 30% of the overall profit. Now, where it gets a little bit odd is like some people, like on mine, for instance, my leverage looked higher because I included all the LP money as debt on my real estate owned schedule. So it just kind of depends on however you structure it in order to give it to the lender. We ended up taking all the LP out because technically it's not a debt, and the leverage looks way better, way cleaner if that's not listed on my REO schedule. So I had to adjust it over here in order to make that difference.
You know, on that exit, the way I do it on my personal financial statement because I'm an LP too, we're very similar. So like, let's say it's I don't know, I'm gonna make this up, 1,000 units, and I might have $2 million in those 1,000 units just as an LP. But on the OM, on the offering memorandum, the people who you're working with as a syndicator, your syndicators are saying, okay, that exit's going to be a 2x multiple in 5 to 7 years, right? So if I had $5 million in that 3,000 units or 1,000 units, whatever it is, I just show that as a 2x multiple because it's the equity sitting inside there, and I hadn't had a pushback from the bank yet on that, so I don't list every one of my LP positions because it would be 40 pages long, you know?
Yeah.
So I just list the number of units, the number that I have inside those units, then plan for a 2x multiple in that 5 to 7 years, and I hadn't had a pushback yet.
Yeah. No, it's good. I mean, here's the key the way I've learned about this entire finance world is by having conversations with these guys over and over. Bring them a deal, talk through it. Bring them another deal, talk through it. Bring it to them before you're looking to refinance, or 6 months before the rent, or 3 months before the renovation's done, and just talk with all of them all the time on what are the options, where's the market at right now, and what can this look like. And it's like going to the gym, right? You're just putting in the reps, having those conversations. You learn a little bit every single time, and you learn more and more over time. And so you don't need all the answers. What you need to know is the who to do the how, the who to do the what. And these are some phenomenal resources for you guys here in Legacy Family that you can reach out to at any time. Pepper them with questions. They're going to point you in the right direction and at least get you on track to be as bankable as you possibly can be for whenever you're looking to take down that deal or refinance that deal. So, feel good? Can we give them a round of applause?